Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, my guest is Sebastian Stewart, who's partner at Pacific Asset Management. Really exciting time for you. You launched your first exchange-traded fund. It's a really interesting one. It's an emerging markets ETF with a value-oriented strategy. Can you tell us a little bit about it?
Yeah, Sumit, thank you so much. Yeah, we're absolutely delighted to have launched our active ETF in partnership with emerging market equity specialist North of South Capital. The fund's ticker is GEMI, so we hope that will be engraved in investors' minds from this point forward. And the fund is a little bit unusual. Really, the objective is to provide investors with broad exposure to global emerging markets and really to offer access to what we believe to be great quality businesses that are also undervalued according to our valuation framework. And really the things we're looking for when we're looking at the quality of businesses are really well managed companies that have a great competitive advantage that is defensible, that are also have great pricing power, that are cash generative and are able to deliver that cash to us as shareholders in the form of dividends. And the final part of the equation is to find the businesses that have all of those characteristics that also offer significant levels of upside to our investors. So that's really our goal. And I think what differentiates our approach from many other emerging market funds, and particularly value emerging market funds, are that we're not deep value investors. We're not trying to find turnaround stories or those stocks that have been completely beaten up. What we're really trying to do is identify risks and incorporate that into our valuation of businesses. And really, we look at risk through the prism of macroeconomic risk, and within that, currency risk is extremely important because we want to deliver returns in US dollars to our investors. That's important, and so currency between local currency and US dollars is really important. And the other thing that we spend a lot of time doing is focusing on the risks that are inherent in the underlying companies themselves. And in that way, we hope to find quality businesses and discount their cash flows in such a way that enables us to have a lot of upside with the underlying companies.
Okay. So speaking of risk, Sebastian, when a lot of people hear emerging markets, their mind immediately turns to China. That's been the dominant force in emerging markets ETFs. We've seen a lot of volatility over the past several years in Chinese stocks. We've seen a downturn, and then last year they kind of pushed back up, a big spike in the middle of last year, and they came back down, and then now they're showing signs of life again. What do you think is going on with Chinese equities? Have they finally turned around after a multi-year downturn?
Well, we certainly hope so. That's the starting point. What I would say is that China is an oft misunderstood market, and investors over the last 5 years in particular, really overlooking the last 10 years in total, have had a real roller coaster ride in allocating to China. And as a result, it's not surprising that investors have quite contrasting views on the market. The other important point to note is that President Xi is really all of the power and the decision making is consolidated with him, and nobody really in this world knows how he's going to act apart from himself. So on the whole, it's quite difficult to understand how China will behave as an overall market. But the key thing here is that you need to take really a fundamental stock picking approach to be able to unlock the value which we see in abundance in China. And by really focusing in on the companies themselves, you can start to build a much higher degree of reassurance on outcomes in the foreseeable future. Whereas if you look at the overall market as a whole, it's very difficult to have any certainty about how things are going to pan out. So I think that's the first point to note, is that it's really important when considering China, which is a huge part of the emerging market index, and even a significant part of world indices, to take a forensic bottom-up stock picking approach in order to be able to unlock the value. And obviously, GEMI is a stock picking approach, and so it lends itself to that. The second thing to note is that there really are some world-leading businesses in China. And I think that the news, particularly recently, has been abundant about the level of innovation and efficiency within the Chinese, particularly tech sector, but really it's much more far-reaching than that. That today you really have some of the most competitive, world-beating businesses within China that, from a competitive position, is extremely attractive. Now, furthermore, a lot of these businesses are extremely well run. They are not indebted like many other developed market companies. They're also extremely cash generative. And a lot of the time they're paying out this cash to us as shareholders in the form of dividends. And as value investors that are very focused on cash flows, this is exactly what we're after. We're looking at good companies with good competitive positions that are well managed, that are cash generative, and where the cash is coming back to us as investors. The final point to note, which is crucially important for us as value investors, are that companies in general in China are trading at rock bottom valuations not seen for as long as a lot of investors have really been in the market. And so you've got access to these incredible businesses that are also trading at rock bottom valuations that are really assuming that nothing can go right from here. And we think that is often the perfect moment to be looking at these opportunities. And according to our models, there are many companies that we've been looking at that have 100+ percentage points in upside, which hopefully we'll be able to capture and pass on to you as investors. Now, as I say, it's not the right approach to invest passively in China and to take a broad brush approach. It's a very deep market. There are plenty of companies that we wouldn't touch with a barge pole for any number of different reasons. What's critically important is that you are selective and you're able to find the companies that are really the diamond in the rough and that demonstrate the characteristics that investors like us are after. We have a reasonably concentrated exposure to China in terms of the number of stocks. So we probably have about 15 stocks within GEMI that are in China. And if you think of a total universe of 1,500 investable companies, we only need to find the real fraction that we absolutely love to be able to generate excellent returns for our investors. So hopefully that provides a bit of color on China.
Great points, yeah. And I'm looking at the portfolio right now. Looks like Taiwan Semiconductor is the biggest holding, followed by Alibaba, and we've seen a massive run in shares of Alibaba recently, almost doubling over the past couple of months. Sebastian, one of the other thing that's been top of mind for investors when it comes to EM is this whole trade war situation. President Trump has threatened to put high tariffs on China. He's put already, I think, 10 or 20% tariffs on that country, and that he might put reciprocal tariffs on other countries, and a lot of EM countries might be impacted by that. Do you have any sense of, how these trade policies might impact EM economies and EM stocks?
Yeah, well, I think the first point to note here is that there was, before the Trump administration started, there was a lot of talk about tariffs and the fact that they were going to be very aggressive and very punitive on markets like China. And as we've discovered quite quickly, actually the tariffs in general have not been nearly as severe as the market initially feared. And that's obviously positive. And no one knows where things will go from here. And the situation is certainly dynamic. But I think that what has also become apparent is that the Trump administration has probably been using the threat of tariffs as a bargaining tool in order to negotiate deals with markets across the world. So not only emerging markets, but also the likes of Canada and Europe. And so I think that, overall, we've been, I would say, pleasantly surprised by the more moderate nature of the tariffs. And I think that we probably, expected that the rhetoric was was on the strong side. It's not the first time that a lot of this sort of rhetoric has been used by the Trump administration, certainly in reflection of the previous administration. But I think that actually the impact has been more moderate than people were fearing. Now, there is also an additional impact, which is that, and again, this is something which is often overlooked, which is that tariffs can often have, and this is even in cases where they're more severe, can actually have very positive impacts over the medium to long term as markets need to become less reliant on exports because of the less competitive nature of their exports. And as a result, they need to look much more introspectively at their own economies. And oftentimes it leads to greater levels of efficiency and higher degrees of innovation. And there was a real focus on how to compensate for the lower levels of exports by increasing domestic consumption and efficiency within the market. So actually, it can lead to really positive impacts on the market. I mean, one obvious case in point is the innovative leaps forward we've seen in things like DeepSeek, which there are lots of different reasons why this came about, but it's certainly as a result of a lot of the trade conflicts that have happened in regard to the chip manufacturing and technology relating to AI and the chips. And it's that has encouraged China to develop their own capabilities so that they're less reliant on third parties. And this is the sort of phenomenon that can come about as a sort of positive externality from the imposition of tariffs.
Really interesting point. Sebastian, my last question is kind of a two-parter. I want to know, why do you think active management is better than index-based strategies in emerging markets? And secondarily, why do you think now is the time for investors to start allocating to emerging markets? For many years, people have been saying buy emerging markets, but they've kind of underperformed US markets. Why is now the time to get in?
Yeah, two important questions. Coming to your first point first about why active management is important. Emerging markets are a very disparate group of markets that are very esoteric, that operate very differently, have very different dynamics, have very different regulatory regimes. And as a result, it's really important to discriminate between markets in order to be able to unlock value. And really, as an investor, investing according to market cap in emerging markets, really isn't an appropriate way in order to be able to identify where the really high quality businesses are, and also those businesses that are demonstrating significant upside potential, as we would consider to be value opportunities. So, being selective about the investments that you make within emerging markets is really important. And as we discussed earlier about China, in a market like China where you've got 1,500 stocks to choose from, there are a huge number of companies that we simply would not touch because of corporate governance issues or because of opaque accounting, or for other, state control, or for various other reasons that may be unattractive for us. But there are, despite that, a great number of businesses that we absolutely love and would love to own. And that just goes to show that by having a sort of broad brush market exposure to China, not only means that you get some access to the kind of companies that we like, but off the back of that, you also get much more significant exposure to a lot of the companies that we dislike. Whereas if you invest in much more of a stock picking concentrated portfolio, you can really identify the sorts of businesses that you want to hold without being exposed to the sorts of companies that may be very indebted or maybe have corporate governance issues that we may not like to own. So it is really important to sort of look under the surface with emerging markets and try and identify the pockets of opportunity, of which there are many. So I think active management and certainly running concentrated portfolios is really important. I mean, there is another commonly understood feature of emerging markets, which is that the informational efficiencies within emerging markets tend to be far greater than in the US market, for instance. And as a result, as bottom-up analysts, really, getting to grips with companies, meeting management teams, understanding about business strategies, and really doing the forensic research, there is a lot more value in principle to be unlocked by going through that research process than in large cap US market, where stock prices on the whole reflect all the information which is readily available, and there's not much additional information to be found. So the informational sort of opaqueness of emerging markets and the inefficiency of the pricing in emerging markets means that it's a very sort of fertile ground for stock pickers like us. So that's why we think active management is particularly beneficial within emerging markets. And why now? If you look back at the history of emerging markets over the last 30 years or so, we've had huge periods of outperformance by emerging markets. We've had huge periods of underperformance, followed by huge periods of outperformance, now followed by huge periods of underperformance, both relative to the US and relative to developed markets more generally. And we are now really at a trough, not only in terms of relative performance, which is only one way of looking at the world, but more importantly, if you look at where we are from a valuation perspective, we're at trough multiples versus the US. And as a value investment firm, as a contrarian investor, at what point would I be interested in looking at any market, let alone emerging markets? I'd want to be looking at that market when it's underperformed relatively for an extended period of time, and when valuations are extremely cheap. And that is exactly the scenario that we're in at the moment. But what's important as well is that as an active manager, we don't mind too much about beta. We're not there to provide beta to our investors. What we are there to do is to provide alpha. And if you look at what's been happening to emerging markets over the last 10 years or so, okay, they're up about 20% over 10 years. They've been annualizing 1.5-2% a year over the last 10 years. Very pedestrian, and totally understand that investors may not have wanted to get involved with that. But if you look at the north of south strategies, they've been able to generate between 4 and 6% additional performance on top of the market performance. So in a way, it's a great thing for us if the performance of the market overall remains muted, because we're able to deliver exceptional outperformance to our clients, and on a relative basis, that looks good. And the hope is that when emerging markets come back into favor and the markets start to recover, we'll be able to retain that level of alpha. And so we'll have a kicker that not only will be able to benefit from the uptick in markets, but also will be able to deliver outperformance in excess of that. That's the hope anyway. But obviously the proof is in the pudding.
Fantastic. Well, I think that's a great place to leave it. Sebastian, you gave us a ton of great insights. I want to thank you for your time.
It's my pleasure. Thank you very much.